Hi, welcome back. In this, the third and final session on value investing, I'd like to take a look at where we've gone in the first two sessions. In the first session, I talked about what I call the glory days of value investing. Much of the 20th century, low PE and low price to book stocks outperformed high PE and high price to book stocks, and most of the legendary investors seemed to come from the value investing crowd. Then in the second session, I talked about the dark side of value investing, which is even in the glory days, there were some days that were not that glorious. In particular, there were periods of time where growth investing beat value investing. And on top of that, active value investing didn't seem to add much value to just picking low PE or low price to book stocks. I ended that session by looking at why value investing has failed, especially in the last decade. Now, leading it from 2010 through the COVID days, it's quite clear that the punch that value investing once delivered is no longer there. Low PE stocks are underperforming high PE stocks. Non-dividend paying and low dividend paying companies are doing better than high dividend paying companies. And I suggested that the reason you give for that phenomenon will lead to what kind of action you will take. For those who believe that this is a passing phase, all you have to do is wait. For those who think that this is all the work of the Fed, even central banks will lose power and you just have to wait again. But I said it could also be that the world has become a flatter place. Things that were exclusive, being able to find the data and work with it, are no longer exclusive. And on top of that, even in a changing economy, it might be time for value investing to re-examine how it approaches investing. In this session, I'd like to build on that concept. I'm going to argue, and this is just my point of view, and of course you can disagree with me, I think value investing has lost its way. There was a time when value investing brought something to the table. Maybe when Ben Graham published Security Analysis, it clearly made a difference. But since those days, value investing has lost its way. And in fact, there are 3 R words that I use to describe value investing, and none of them are complementary. The first is value investing has become incredibly rigid. It is full of things you're not supposed to do. You can't invest in stocks that don't make earnings. You can't invest in tech companies. By carving these rules, value investing has removed larger and larger segments of the market from your universe. It's also very ritualistic. There are things you're supposed to do as a value investor, and God help you if you deviate from the script. What are these things? You're supposed to go to Omaha every year. You're supposed to pay homage to Warren Buffett. You're supposed to claim you read Ben Graham's Security Analysis. And finally, value investing has become very righteous. A lot of finger wagging in value investing, where they tell the rest of the world how shallow they are, how speculative they become, how they will get the punishment that is coming down the pike. It's rigid, it's ritualistic, and it's righteous. So I would argue that for value investing to rediscover itself, it's got to go back to basics. And I'm going to make 6 suggestions. And again, you can add to these suggestions and remove those you don't agree with. But here are my first suggestions. If you're a value investor, I would expect you to even understand what value is. I am amazed at how many value investors I run into who have no idea what the difference is between value and price. You've seen me use this distinction before, but value is driven by cash flows, growth, and risk fundamentals, and price is driven by demand and supply, mood and momentum, behavioral factors. And the reason I emphasize this is if you're a value investor, you should be focused on value, not on pricing. That said, if you look at how value investing approaches the world, almost every tool that value investing uses is a pricing tool. You pick low PE ratios, that's not valuation, that's pricing. So while value investing talks about value, much of what you see done in practice is pricing. And if you truly accept the fact that value is what you're searching for, we know what drives value. Value is driven by cash flows and discount rates. Cash flows are driven, if you want to break them down, into how fast revenues will grow, what your margins will be over time, and how efficiently you can deliver growth. And the discount rates, or what you demand as a rate of return, will be driven by a risk-free rate and a risk premium. This is true for all companies. And to the extent that there's a risk of failure, you have to bring that into value. Now, if you're a value investor and you believe these are the drivers of value, we're ready to take the next step. And the second step is you cannot make avoiding uncertainty the center of your investing game. Unfortunately, that's become true for value investing. I can't buy that stock. Why? Too uncertain. That's absurd, and here's why. If you think about companies moving through the life cycle, young companies, teenage companies, companies at the peak of their life, middle-aged companies, aging companies, declining companies, it is true that there's far more uncertainty early in the life cycle than in the middle of the life cycle. If you say that you're going to avoid uncertainty at any cost, here's what's going to happen. You're going to be stuck in the mature phase of the cycle, and all you're going to be doing is valuing mature companies. You're removing from your investing universe all those undervalued young growth companies. And remember, young growth companies can be in fact, they're more likely to be misvalued than older, more mature companies. You cannot make avoiding uncertainty the name of the game. The reality is there are no valuations that are certain. The kinds of uncertainty you might face might vary across the life cycle, and there might be more uncertainty early and less later on. But uncertainty is a feature of investing. You can't make it go away. Now, building uncertainty valuations, people often think about this in only one terms. I'll use a higher discount rate. But there are lots of places you can bring uncertainty to valuation. Risks in terms of micro and macroeconomic risk can show up and will show up in your cash flows. And they will also show up in your discount rates. So when you think about uncertainties of every type, there are so many places in valuation you can bring them into play. And I'll give you one simple example. Let's say you're looking at a company with only 3 customers. You're saying that's risky. That's a big customer. What if I lose them? There's a way in which you can bring this into valuation where you don't have to just talk about the risk. You can incorporate into value. What I'm arguing for is don't let uncertainty stop you from making estimates. If you make the assumption that if your estimates are wrong, it's not worth making those estimates, you've lost your way in valuation. Now, of course, we talk to value investors. They say, but I don't believe any of the uncertainty stuff that you do in valuation. I just use a margin of safety. I'll be quite honest. The margin of safety is a measure that's marketed to do things it cannot do. Remember, it's not a substitute for risk assessment. I know value investors don't like betas. And guess what? I don't like betas that much either. There are lots of things about modern portfolio theory that I disagree with. So when people say, look, I don't like betas, and that's why I'm not doing discounted cash flow valuation, I don't get that. You can not like betas and still do discounted cash flow valuation. You're saying, how? All I need is to substitute something else where I use betas. And in fact, I do a series of sessions where I give people a bunch of alternatives to betas. These alternatives will depend upon what it is about betas you don't like. Because when people tell me they don't like betas, it's because they dislike one of the underlying assumptions that are made to arrive at betas. The lead assumption that all risk and return models and finance use is the marginal investors in your company, the investors setting prices, are diversified. Is that an assumption? Absolutely. If you don't like that assumption, then the risk you're going to be looking at is total risk. And that total risk can come from looking at accounting numbers, price numbers. So if you disagree with the assumption of diversification, then I have a follow-up question. Do you believe in price-based measures? So if you dislike the assumption of diversified investors and you dislike price-based measures, I'm going to give you accounting-based measures of risk or even qualitative measures of risk. If you believe in price-based measures, then you can look at the standard deviation, the volatility of the stock price. If you believe the marginal investor is diversified, but you don't like the price-based measures of risk like betas, then you can use your own versions of measures of market risk. It could be accounting betas, where it's based on earnings, or you can look at macroeconomic measures of risk that capture the risk in a company. What I'm trying to say is you don't like betas, find something else that better captures how you think about risk, put it in, come up with discount rates as a way of proxying for risk, move on. You should not avoid doing discounted cash flow valuations because you don't like betas. You're saying, what about the margin of safety? You know what the margin of safety is, right? After you value a company, margin of safety says the price has to be at least 15%, 20%, 25% below that value before I buy. Before you use a margin of safety, you need a value. To get a value, you need a measure of risk. And that's why I don't think margin of safety is a replacement for betas. It's an add-on risk measure. Now, if you talk to value investors, the view is the higher the margin of safety, the better. I'm building in more protection. But be careful, because margin of safety creates a trade-off. And here's what the trade-off is. Let's say you decide to use a very large margin of safety, that you will not buy stocks unless the margin of safety is 40%. The price is more than 40% lower than value. Sounds good, right? What you're doing is avoiding what I call type 1 errors, where you are buying a stock that is really overvalued, but you thought it was undervalued. You're avoiding that kind of mistake. By setting a large margin of safety, you're avoiding buying overvalued stocks by accident. But by setting a large margin of safety, you're also not buying undervalued stocks because you set the margin of safety too large. Which area is larger? I'll give you a very simple thing I would look at. I'll take a look at your portfolio. If you're 80% in cash and 20% in stocks, you're using too large a margin of safety. How do I know that? You're not finding anything to buy. If you're fully invested and you have lots of opportunities, by all means expand your margin of safety. There's nothing inherently good or bad about a margin of safety. It depends on the market you're in and what your opportunity set looks like. Which brings me to my fourth point about value investing. Value investing, for better or worse, is very heavily dependent on accounting numbers. Go take a look at Ben Graham's screens. Look at how many are based on numbers that come off balance sheets. In fact, the value investor's favorite financial statement is the balance sheet, and often the favorite measure of the value of a company is book value. Well, value investors might trust accountants, but I don't. And in fact, that trust in accounting should have become weaker over time, because here's what's happened. As companies have become more aggressive in how they do their accounting numbers have actually lost their have at least decreased in terms of informational value. Earnings now reveal less about a company than they did 20 years ago, 40 years ago. And book value, in my view, has become almost useless. And here's why. As long as accountants are internally inconsistent about how they treat investments in R&D as opposed to investments in plant and equipment, the book value for some companies means almost nothing. There's a reason why the price to book ratio for the S&P 500 has climbed over time. And it's not just because you think stocks are overpriced. It's because book value has lost its way. Now, you're going to wait for accounting to come to its senses. Good luck with that. It takes accounting a long time to recognize its problems, and they're never going to quite get it right. My advice to you is let go of book value. Don't look at accounting as the basis for your salvation, because it's not going to happen. My fifth point pushes back against one component of value investing. Not all value investors do this, but I've heard from some value investors that you shouldn't diversify, that you should hold just a few stocks. And the argument seems to be logical, right? If you have found the most undervalued stock or the 5 most undervalued stocks, why reduce the payoff by spreading your bets across 30 or 40 stocks? So in those stories, diversification is the enemy of stock picking. Again, I don't get this. There are 44,000 publicly traded companies. If I pick 40 stocks, I don't get much choice. In fact, I'm going to argue that how diversified or concentrated you are as a person, as an investor, will depend on 2 things. One is, remember, you value the company and you could be wrong. So it depends on the faith you have in your own valuation. The second is, for you to make money, the market price has to adjust to value. So let's take the extreme scenario. You value the company and you feel absolutely certain about value. And you feel that the pieces are in place for the price to adjust to value with absolute certainty. So you have an undervalued stock, you know it's undervalued, and you know with certainty the price is going to adjust to value. You know how many stocks you should have in your portfolio? Just hold that one. But let's put ourselves in the real world. I have never, in 35 years of valuing a company, ever valued a company say, I feel absolutely certain. You know why? Because there's a real world out there that I don't control. This notion that somehow collecting more information and doing more number crunching is going to make you more certain is misplaced. So I'm not certain about my value. And the less certain you get about value, and the less certain you get about market prices adjusting to value, guess what? You need to get more diversified. So I'm not going to tell you how diversified you should be, but I'm going to be diversified across 30, 40, 50 companies. I have 50 companies in my portfolio. You know why? Because I'm not that certain about my value, and I'm not certain about prices adjusting. If you have views to the contrary, I want you to confront those views and ask yourself, where did that come from? Why do I feel so certain about my value? Why do I feel so certain that price will adjust to value? Because only then can you end up with really concentrated portfolios. Which brings me to my final point. I've made a few suggestions which you can reject or accept. But here's one I hope you take to heart. Don't expect to get rewarded just because you did all the right things. Remember I talked about value investing feeling righteous? Many value investors feel that because they've done the homework, that because they think deeply about companies, that they deserve to get rewarded. Markets don't exist to reward virtue. Markets are not morality plays. They don't sit there and say, this guy did a lot of work, let me give him 37%. But his neighbor picked stocks based on astrological signs, and let's give that person 3%. You can do everything right and have nothing to show for it. Your neighbor can do everything wrong and make 3 times more than you do. And if you feel frustrated and angry, you're setting yourself not just for disappointment, but for doing really stupid things. I've seen value investors double down on markets saying, I'm going to show you who the righteous one here is. So I think it's hubris to believe that you and only you control the investing high ground. It's okay to be a value investor. It's also okay to look at charts. What makes one investor virtuous and the other, I don't know. Why do we call one an investor and the other a speculator? We all want to make money. And my suggestion is keep an open mind. Don't rule out charting and technical analysis. You might be fundamentally an investor in value. But that investing in value doesn't mean that you cannot supplement that philosophy by looking at technical indicators, trading volume and prices. So here's where I end up with after this discussion. I believe I'm a value investor, but not of the grouping that defined value investing in the 20th century. To me, the essence of value investing is I will buy any stock where the price is less than the value, even if it's a growth stock, even if it's a money-losing company. That's my rationale for why I bought Tesla in June of 2019 and Uber in September of 2019. To me, there's nothing in the nature of the company that should rule out certain kinds of companies. So I'm not suggesting my view of value investing has to be yours, but I think it's time that we reclaim the word value, because we can't let it be defined the way it's been defined by some value investors for most of the last few decades, because we've seen exactly where it will take us. So I hope you found the sessions useful, and I thank you very much for listening.